The turn of the month effect. In forecast cycles there are following tactics variants of the turn of the month strategy. The first one is the FNM, first new month. It opens the position at the opening price of the first trading day of the new month. The second one is the last previous month, opens the last trading day of the month. And the L4 PM, last 4 previous months, it opens on the last 4th trading day of the month. All the 3 tactics close the position at the closing price of the 3rd trading day of the month. So basically, a month is ending. Before it is ending, open a position, hold some days and close. In the table below, there is the average return of the turn of the month strategy with LPM tactic applied to the S&P 500 from 1928 to 2021. Considerations. The position is held open for 4 trading days each month. In this table you see the time span in sample, out of sample and all, and the relative years. Then the returns of the strategy with this tactic. The average return of S&P 500 in a period of 4 days. The excess return of the strategies over the S&P 500 in 4 trading days, and finally the excess return in 1 trading day of the strategies over the S&P 500. The average return of S&P 500 over 4 trading days is 0.11%. The average return of the strategy in the entire period is 0.48%, which means a return of 4.36 times higher than the normal one, a definition of an anomaly. Just notice one thing in this table. In the sample period, the excess return, so the anomaly, is much bigger than in the out of sample period. It can be a symptom that the anomaly is vanishing, even if the difference in the entire period is very big. The effect of the option expiration. The days around the expiration of options can be important days, especially for a market that is underlying of options. For example, the option on S&P 500 futures. The reason is that option buyers and sellers strive to push the price in favor when options expire, which often result in non-random price movements. Since options don't expire on the same day every month, a regular seasonal chart cannot measure this effect. On forecast cycles, there are 2 strategies to analyze this effect. The first one is the expiry week. It measures the returns in the week in which the options expire. The second one is in the week after the expiration. Each strategy has 2 tactics. First, US stocks. Expiry dates are those of US stock options, which expire on the 3rd Friday of each month. The second one is on American stock indices. The dates are those of the options on US stock indices, which expire on the 3rd Friday of each quarter, March, June, September and December. You can see a card of an anomaly on the instrument AT&T. The strategy is options, week of expiration, and the dates, the tactic, are US stock indices ones. The first day of the quarter effect. This strategy enters the market at the beginning of each quarter, the 1st January, 1st March, 1st July, 1st September, and holds the position open for N days. According to tactics, N differs. There are 3 tactics on FC. First, it holds the position for 1 day, then for 2 days, and the third tactic is for 3 days. For example, FDQ 3 opens the position on the first trading day of the quarters and closes it at the closing price of the 3rd trading day of the quarter. An anomaly on S&P 500. In his 2014 paper, Why Don't You Trade Only 4 Days a Year?, Jill Cohen found a very short period in which returns on the S&P 500 tend to concentrate, the first trading day of each quarter. Note that this anomaly becomes statistically significant starting in the year 2000. It measures that in the period 2000-2013, by trading only 4 days a year which are about 1.5% of the days. Therefore, in total 56 days in 13 years, an investor could have obtained a return of 113%, about 10% of total return. This is another example of anomaly. In only 1.5% of the days, obtaining about 10% of total return instead of just 1.5% as expected.